Hey, what's going on? This is Jerry, founder, owner, CEO of Wealth DynamX. I wanted to give you a quick video today just to talk to you about investing. Okay, so I see a lot of talk online about investing. It's definitely a fad. It's something of interest, which I think is great. I think more now than ever, people have been interested in investing. But I think most people don't know how to calculate their returns. I think most people look at, whatever chart, whatever graph that they have on, their Robinhood account or their crypto wallet or whatever it is they're using. And so I want to share with you what I actually use when I'm calculating returns on my investments. Okay, so the first one that I look at is the actual yield of the investment. Okay, the investment has to pay me income, and I have to be able to track that income and calculate it. Otherwise, what am I doing? Why would I invest for no income? Why would I put money to work into something that may or may not pay off, that I've got to sell in order to make a profit? By the way, when I sell it, it's taxable. So that's another factor. And it doesn't even have a guarantee of paying me anything. Why would I do that? So I'm looking at the yield. I'm looking at, okay, I want to be earning 8 to 12% yields on an annual basis. Otherwise, I'm not investing in it. Okay. The other thing that I'm looking at is I am looking at something called the compounding annual growth rate. Okay. Compounding annual growth rate means that I take the annualized return, yield, appreciation, tax benefits, or whatever it might be, and I also factor in reinvestment. Okay, so if I'm reinvesting, I'm taking my profits, I'm putting it back into the investment, right? I'm putting it back in, I'm compounding that, and that grows at a greater rate over time, and that gives me an exponential multiplying effect with my investment. So I'm looking at that. When I see a compounding annual growth rate, usually I'm looking at 10, 12 plus, depending on the deal. Sometimes I make 30 and 40 on my compounding annual growth rates. So that's another one I'm looking at. And then the last two I want to share with you is, number one is called return on time invested. Okay. The purpose of investing for me is to free up my time. Okay. I'm investing to free up my time so that I no longer have to trade time for money. So one of my rules is when I invest, I never trade time for the same dollars more than once. So if I trade it twice, it means I worked for the dollar to earn it, and then I invested it and also worked for the same dollar. Doesn't that defeat the point of investing? Right? So I'm never going to trade my time for the same money twice. And so I look at something called return on time invested. If I take my annual yield, let's say I invest $100,000 at 10% yield, pay me 10 grand a year. Okay, if I take that and I divide that by 12 months, and then I divide the amount of hours per month that I have to put into this investment, just for easy math, let's say that, $10,000 a year, that's $833 a month. Let's say that I spend 8 hours per month, finding deals, managing deals, dealing with tenants or paperwork or whatever, and that pays me about $100 an hour. Okay? For me, that's not worth my time. I'm not going to do something that pays me $100 an hour. In my life right now, my time is worth a lot more than that. So I lose money on investments that take my time, which is why I'm a passive investor. So that's called return on time invested. The last one, and this is my personal favorite, this is called the PITA factor. Okay? PITA factor stands for pain in the ass factor. Okay, there's not a math equation for this. There's not a objective way. This is subjective. This is me as the investor. I've got to have enough experience and knowledge on investing to be able to determine when something has a high PITA factor. Okay, what are things that would be a pain in the ass? Tenants complaining all the time, new expenses coming up, volatility, not being able to get out of the investment, having it be illiquid, having it be something that I don't understand, market manipulation. Those are all things that I would consider are a pain in the ass. Okay, and this is something that a new investor is not really going to know. Okay, a new investor is still excited just to be able to say they're investing. So they're going to justify any return they get because it's something they've ever had before. They're not going to invest in their first or second or third deal and then poo-poo the deal and be like, oh yeah, that was stupid. Right? Of course, it's the greatest deal they ever did. But when you're seasoned and you've been doing this for a number of years, you start looking at, okay, these are the factors I don't like. These are the factors that make investing not fun for me. These are the factors that make investing inconvenient. Therefore, I'm going to look at that and I'm not going to get into deals that have a high PITA factor. Okay, so I wanted to share this to give you some practical tips on how to invest better. Again, we've got our yield, we've got our compounding annual growth rate, we've got our return on time invested, then we have our PITA factor. If you stick with those will guide you into the right deals. Okay, and there's more to it than just that, but these are the 4 that I use the most. I hope that helps you. If it did, make sure that you like the video, share it, follow us. We're going to be putting out tons more content like this. And if you're looking at this and you've been following me for a while and you'd like to become a client or just jump on a call with my team and see if we can help you, reach out in the comments, send me a direct message, and I'll get you set up with a free call. Until next time, have a great day.